Hey friends, Chris Garceau here, your favorite loan officer with a strong focus on my veteran community. Welcome back. So why the VA loan is different? First, let's establish something important. The VA loan is not just a conventional loan with a patriotic sticker on it. It was designed to give veterans 100% financing. No monthly mortgage insurance, very competitive interest rates, and flexible qualification guidelines. In the conventional world, 20% down avoids PMI or private mortgage insurance. In the VA world, PMI doesn't exist. That changes the entire conversation. You're not required to save for years just to avoid a penalty. That's huge. So first, let's talk about when zero down is actually the smart move. There are real strategic advantages to putting $0 down on a transaction. First, liquidity. Cash in the bank gives you options. Homeownership comes with surprises. Repairs, maintenance, life changes, PCS moves, all the things. Draining your reserves just to say you put money down can leave you house rich and cash poor. Second, opportunity cost. If you have $25,000 saved, you have choices. You can invest it, keep it as reserves, use it for future property when you PCS. When you put that money into the house, it becomes illiquid. You don't access it without refinancing or selling. And third, inflation and appreciation. If home values rise while you're waiting to save 10 to 20% down, you may end up chasing the market upward. In some cases, waiting to save actually makes the home more expensive. And leverage, when used responsibly, can be powerful.
Write that down.
So now let's talk about when saving for a down payment can be a smart play. First, reducing the VA funding fee. If you're not exempt due to a disability, the funding fee decreases when you put at least 5% down and decreases again at 10% down. On a purchase loan, it's your first time use. Zero down is 2.15%. It is financed, but it's a cost. At 5% down, it drops to 1.5%. At 10% down or more, it drops to 1.25%. On a subsequent use, zero down is 3.3%. That's pretty hefty. 5% down is 1.5%, and 10% down or more drops to 1.25%. On larger loan amounts, that can mean significant savings, especially if you're on your subsequent use VA loan, meaning that you've used it before.
Noted.
Another reason is lowering your monthly payment. Putting money down means you're financing less. A lower loan amount means a lower principal and interest, potentially improved debt-to-income ratios, and more monthly breathing room. For some families, payment comfort matters more than liquidity. I get it. And lastly, appraisal gaps. The VA does not allow you to finance above the appraised value. If the home appraises low and you want to proceed, the difference must come out of pocket or negotiated with the seller, which doesn't always happen the way you want it to. In competitive markets, this sometimes functions like a down payment, even if that wasn't your original plan. So to circle back, the biggest mistake I see isn't putting money down. It's blindly applying conventional thinking to a VA loan. People often tell me, I was told I should always put 20% down. That advice is built around avoiding PMI. VA borrowers don't have PMI. So the question isn't, should I put 20% down? The question is, what does this money do for my overall financial position? That's a completely different conversation.
I'll keep that in mind.
Here's a simple example. Let's say you're buying a $500,000 home. If you put $25,000 down, you might lower your payment by a couple $100s a month. That's meaningful. I'm not saying it's not, but you've also tied up $25,000 in equity that you can't easily access. If that same $25,000 stays invested, builds reserves, or positions you to buy your next property during a PCS, the long-term strategy might look very different. There's no universal right answer. There is only the right answer for your mission. The VA loan is one of the most powerful wealth-building tools available to veterans. But power only works when it's used intentionally. Saving for a down payment is not automatically smart. Putting zero down is not automatically smart. The smartest move is understanding the trade-offs and choosing strategically. If you're a veteran trying to decide what makes sense for your situation, let's run the numbers. We'll look at liquidity, long-term plans, funding fee impact, and monthly payment comfort. Make the decision based off math, not myths. And if you want help breaking down your specific scenario, that is what I'm here for. Use the benefit you earned. Just make sure you're using it strategically. As always, I appreciate you tuning into my channel. I'm obsessed with taking care of my clients, especially my fellow veterans. If you can do me a favor and subscribe to my channel, it would mean the world. I'll keep pumping out content and make sure you get notified. Thank you for your service, and I'll see you on the next video.